Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Pharmaron Beijing Co. Limited annual report. Pharmaron Beijing Co. Limited offers a wide range of pharmaceutical research and development services across various segments. The company provides laboratory chemistry and biological science services, including small molecule chemical drugs, oligonucleotides, peptides, antibodies, antimicrobial agents, and cell and gene therapy products. In addition to laboratory services, Pharmaron also offers contract development and manufacturing organization, CDMO services for small molecules, such as API process development and production, material science and formulation development, and analytical development. The company's clinical research services include drug discovery, development, and production, as well as gene therapy drug development and production. Pharmaron also provides macromolecular and cell and gene therapy services, including laboratory services for cell and gene therapy products. Furthermore, the company offers technology development, technology transfer, technical consultation, technical services, and technical training. Additionally, Pharmaron is involved in the import and export of goods and technologies. Pharmaron Beijing Co., Limited, maintains a market capitalization of $57 billion, broadly in line with the industry peer group. Pharmaron Beijing Co., Limited, trades at a lower price-to-earnings ratio of 20 times and a higher price-to-book ratio of 2.17 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 42% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the increase in aggregate revenue by RM 819.3 million, 14.8%, is a significant indicator of growth. Additionally, the clinical segment revenue increased by 8,158,885 RMB0, while laboratory segment revenue rose by 1,956,669 RMB0. The CMC development and CGT services segment also saw an increase in revenue. Furthermore, the company's expansion into new markets, including the EU and China, contributed to its growth. The adoption of AI technologies and investments in digitalization and automation have improved service capabilities and efficiency. Collaboration agreements with universities have accelerated the application and adoption of promising digital healthcare, biopharmaceutical, and life sciences technologies. The company has also seen an increase in purchase orders for laboratory services, breakthrough progress in large-scale collaboration projects, and expansion of R&D services for new drug modalities. The proportion of bioscience services exceeding 56% is another indicator of growth. Overall, the company's revenue growth can be attributed to a combination of these factors. On the other hand, the primary drivers of revenue decline are fewer in number. The decrease in profit attributable to owners of the parent due to investment income generated from disposal of equity interests in PROTOLOGIX, INC, is one factor. Additionally, the biologics segment revenue decreased by -1,482,932 RMB0, while the CMC development and CGT services segment saw a decrease in revenue. The laboratory segment revenue increased by only 0.5%, which is another indicator of decline. The decrease in profit attributable to owners of the parent, 7.2%, basic earnings per share, 6.8%, and diluted earnings per share, 7.1%, are also contributing factors to the company's revenue decline. The company's debt level has undergone significant fluctuations over the past year. Initially, it increased from RMB 1,047,309 in 2024 to RMB 4,766,489 in 2025, indicating a substantial rise. However, this trend was short-lived, as the debt level decreased to RMB 1,771,806 by the next reporting period. Furthermore, there were instances of both increases and decreases in debt levels, with an increase of approximately RMB 1,514.3 million from RMB 5,024 million to RMB 6,538.3 million, followed by a decrease of RMB 101.2 million. In terms of interest expenses, the available information suggests that there was no relevant data provided for certain periods. However, it is noted that interest expenses on bank borrowings decreased from RMB 199,164 to RMB 195,341, and total interests decreased from RMB 243,718 to RMB 192,805. These decreases indicate a reduction in the company's interest expenses over time. The financial performance of the company can be summarized as follows. The laboratory services and clinical segments were standout performers, with notable growth in North America, Europe, China, and the U.S. These regions demonstrated strong demand for the company's products and services. In particular, the UK within Europe and Singapore showed impressive results. On the other hand, the biologics segment struggled to meet expectations, indicating a need for improvement in this area. Additionally, while Europe as a whole performed well, there was one notable exception, the region excluding the UK. Management is optimistic about the company's outlook, highlighting several key strategies that will drive future growth. One of the primary focuses is global expansion, with plans to continue expanding into new markets through its existing operating facilities in the UK and US. In addition to global expansion, management is committed to investing in AI technologies to improve service capabilities and reduce operational errors. This investment is expected to have a significant impact on the company's operations and will be a key driver of future growth. The company is also prioritizing sustainability and environmental responsibility through its ESG and sustainability strategy. This includes decarbonization initiatives, sustainable supply chain development, and improved supply chain management processes. Furthermore, management is committed to building an end-to-end platform that integrates multiple modalities and has global footprints. This will enable the company to meet evolving R&D needs and increase efficiency through innovative technologies. Overall, management's outlook for the company is positive, with a focus on growth through global expansion, investment in AI technologies, and prioritization of sustainability and environmental responsibility. The company's dividend payment history reveals a consistent trend of distributing profits to its shareholders. As per the provided summary, it is clear that the company has paid dividends in various years, including 2021, 2022, and 2023. The proposed final dividend for 2025 was also mentioned, indicating that the company plans to continue this practice. The amount of the dividend payment varies from year to year, with a proposed final cash dividend of RMB per 10 shares in 2025. This translates to an aggregate amount of approximately RMB 366 million for the year ended December 31, 2025. The company's commitment to paying dividends demonstrates its focus on returning value to its shareholders. It is worth noting that there is no mention of share buyback in the provided summary. Therefore, it can be concluded that the company has paid dividends but has not engaged in share buyback activities. The company's financial performance has raised concerns about its inventory management. A significant increase in the cost of sales by 43% suggests that the company may be struggling to manage its inventory levels effectively. Furthermore, the mention of impairment losses on inventories indicates that some of these items are no longer saleable or have become obsolete, resulting in a financial loss for the company. These issues collectively point to potential problems with inventory buildup and supply chain disruption, which could have long-term implications for the company's profitability and competitiveness. That concludes the financial summary for Pharmaron Beijing Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.